Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, August 10th, 2021. What we'll do is start out with a very brief update on the near-term outlook for the equity markets via the 60-minute charts. We'll just look at SPY and QQQ. Really nothing new to report there today, but I'll highlight some levels and developments to watch. Then I want to change gears, go out to the longest term time frame that I look at, and that's in response. I spent some time this morning catching up on some of the recent comments on the site. Somebody talked about, Randy's been pointing out divergences for a year, and I'm going to show you why. We're going to take a look at the a monthly chart going back 60 years, I think, on the S&P 500. Then we'll roll into updates very quickly on crude, nat gas. Time permitting, I'd like to get to gold, euro, the US dollar, just to do an update there. I want to talk on that. And another update on bonds. I recently highlighted some breakdowns in Treasury bonds, and somebody in the comment section that mentioned LQD, which is the investment grade corporate bond ETF. So I'm going to talk on that, what that means. And then finally, on a related note, because I do see more downside in bonds, which means upside in rates, especially long-term rates, and so what we'll look at are the REITs and utilities, because those are two of the 11 sectors in the S&P 500. And even though they don't move the needle much, we may see some trading ops there. Okay, so dive into it. S&P 500, really no change in the last few days. We're kind of grinding in this range here. And what I've done is both the SPY and QQQ on these 60-minute charts. I put same levels I've had. I just color coded them here. That's about 438 right here. I have a purple line, and then the lower one's about 436. So it's more of a support zone, and obviously if the bottom of the zone goes, that's all the better for a sell signal. So these are divergences. They continue to build. We had divergence here. It's not as if it didn't play out. It did, and we certainly had a correction, but we've extended those divergences. And trend line I'm not crazy about because we don't have numerous reactions. We have one there. Well, we do have numerous, but these are just in a tight cluster. So again, I think that could do the trick, the pop of the trend line, but you do want to see that support zone taken out for the next sell signal on the 60-minute time frame. Again, I always try to make a point that the shorter the time frame, the shorter the trade is on a buy or a sell signal. Typically 60-minute charts are good for swing trades lasting just days to maybe a couple weeks, and then when you go out to the daily charts, you're talking a few weeks, a couple weeks to a few months potentially, depending on the pattern in the scope of the divergences and trend line and everything else that you're looking at. And then, of course, you go out to the weekly and monthly charts, and that even helps you gauge the bigger trend for investments, trend positions. QQQ, same story, nothing new to report. Recent range right here, and I have that colored up those lines. The lower of which is at about 360.50. Up to about 361.80 or so. Let's call that a support zone. So if the bottom of that goes, that should open the door for a downside move. Divergences continue to build. Last time we had a divergent high, we had a breakdown, really minor correction, back tested, and so far we're still, since we back tested, so it's not as if if you took this sell signal, you're slightly underwater. We're talking maybe less than 1% or so right there from the sell signal to where we're at. And from the back test, if you shorted the back test, well, you're a little bit positive there. So all in all, if you shorted half position there, half there, you're just going sideways. You're not going anywhere. You're not down. You're not up. Relatively speaking, trade's not going to play out unless this gets taken out. So that's still indicative, and that's what I want to talk about here. How these divergences are not, again, the divergences in themselves are not buy and sell signals. They are merely indications. An indication that a trend change is likely pending. Let's go out to the longest term chart I have here on the S&P. This data feed goes back into the 60s. So we're going back to 1962. All right, so we're looking at 60 years of trading history, almost 60 years. And here's why I point out the divergences. Again, they are conditioned. They are not a sell signal because they can continue to build. They can Sometimes they don't play out at all. They get taken out or negated, and that happens when prices are making for negative divergences. And by the way, everything I'm saying here holds true in reverse for positive or bullish divergences. They build. They're indicative when you're in a downtrend that a trend change is likely coming. And as I say, they don't always play out, but more often than not they do. More often than not means well over 50% of the time. I don't have an exact statistic on it. And it varies over time, but in this case, I just want to show you, and this is a chart I've shared before. So divergent high 1, 24% correction, divergent high 2, and I label them 1, 2, 3 because that's a series of consecutive divergent highs. Each of those, as you see, the divergence got bigger and bigger as it built, and it's not as if each one didn't play out. 24% drop, 37, and then a 50, finally resulting in a 50% bear market that wiped out half the value of the stock market at the time. That was back in the 70s. Glancing at this chart, unless I missed something, I don't see any divergences to this point right here. That was Black Monday in 1987. It was very quick and fast, but it was measured out roughly a 36% drop. And then we pushed up, made a marginal new, I don't know why that DH isn't there. I got to put that in. Marginal new or extended the divergence, I should say, and we had at this point before Black Monday we had divergence only on the RSI right there, not on the PPO. But then we pushed higher and put in another divergent high and then a 20% drop right there. Fast forward, divergent high right here. This was the dot-com bubble, if you guys remember that, popped in early 2000 and wiped out about half of the stock market's value right there, about a 50% drop. There was the Great Bear in 2007 to 2008, roughly, again, I just grabbed the top line. These are rough measurements, about 58, but going from memory, I think it was about a 56% drop in the S&P 500. Divergent high, 15% drop. Okay, so let's just fast forward to today, and we'll talk about, for the last year, what we've had. We had divergence here. There was a shot across the bow. Some of you might remember that was a correction back in the fourth quarter of 2018. Markets fell almost 20%. Some indexes actually exceeded a 20% drop. The S&P was right around there, a hair under. Then the COVID hit, and we had, again, divergences. So that was back in 2020, 35% or so drop. 1/3 of the value of the market was chopped in half. Doesn't look like it here when you use log scaling, but that's what the drop was, 35% or so. And now, so there it is. There's our divergence. Clearly, we're still diverging on the RSI, not the PPO at this point, just like sometimes you have one or the other. Usually it's going to be RSI divergence. And so why did I talk about it again? I'd be remiss not to. Does it guarantee a correction? Has it been building for a year? Actually, no. It's been building for really this divergence from this point back in early 2018. We had a series, so far 2 corrections, and this is DH3. It's just gotten larger and larger. Does it pan out ultimately for a drop? I think so. Why? Well, again, if you gamble, if you go to the casino, or anything you do in life, you play the odds. That's what a lot of things are about. You calculate the odds to see if it's worth it. So you go back in time and you look at these drops, and much more often that does play out. And it also tells us typically the bigger the divergence, the longer they've been building, for years instead of months, the bigger the drop. So not always. It's not a set formula, but that's what's there. And again, divergences are not a sell signal. Sell signals come. We'll look at the weekly chart. And we'll look at things like, I don't have a clean trend line, maybe a bearish candlestick pattern, but there's no sell signals on the weekly right now. For months now, I've been highlighting some mostly on the 60-minute time frame, a couple daily chart sell signals on the daily time frame. And again, it's not as if they haven't played out for corrections. You can see, well, I've been more active on QQQ on that. There's all your corrections, divergent highs, corrections. So this is swing trading. So again, I'm speaking to that, the poster, the person posted that comment section for last year and talking about 401k. That's 401k stuff. You don't trade your 401k on a 60-minute chart. You can help time entries, pullbacks, and you find divergent lows, go long, add to positions, maybe take some off when you get these divergent highs, especially when the sell signal comes, the breakdown right here, the back test, things like that. All right, enough on that. Just wanted to share that is why I point out the divergences. And if 6 months from now I'm still pointing out the same divergences on the monthly charts, a long-term time frame, so be it. They either play out or they don't. But you don't short or go long on divergences in themselves. You wait for the buy or sell signals that, of course, follow those divergences. Okay, fast forward. Again, market's been grinding around. Opportunities lie elsewhere. DM, I like, and I have to tell you right now, I had, and I talked about this before, on the earnings calendar on the site, earnings.com, they give you, when you go far out, they give you an estimated date. They can just base on last time a company reported, and then when you get closer to earnings, they usually refine. Well, a company doesn't tell you. They announce their earnings date when they get closer to the exact date on time. So we do have now, at least they revised it to August 11th, which is tomorrow. So I imagine that's accurate. I haven't verified. You can always go to a company's website, go to the bottom of the website, and there's usually a link for corporate information, corporate press releases, and things like that. So if you want to know definitively when your company reports, don't put too much stock in the earnings.com and those other sites. They can be wrong. Go to the company's website. So I'm going to assume this one's reporting tomorrow. Still like it. But I have to throw out that risk. When you hold a stock into earnings, it is always a gamble. It can go either way. To me, the charts indicate the most likely outcome is a positive result after earnings. And I'm not speaking what might happen tomorrow after the bell on the initial report earnings, or if they do a conference call, what happens after that. I'm talking in the coming days to weeks. Typically, if a chart is clearly bullish or clearly bearish heading into earnings, that it determines which way the stock is going to go. Typically, not always. There are no certainties. That's the daily chart. So here's a little minor resistance right there. If it can pop that, then pop $10, it can still run up. And this is a longer term swing target with a midpoint target right around there, about 12. But I think this one has the potential to get up to this $15 area. And who knows, maybe all the way up here to the 2140-ish area. The targets I laid out on this trade are here on this 60-minute chart. And we've already, well, now we've hit T1, it's only right hit. T1 was just hit. And gosh, trying to remember, it broke out. And I picked it up here after it broke out and back tested, so it was somewhere in here. So I can't tell you the exact percentage. It should be a double-digit gainer from where it was first pointed out as a trade idea, close to it. But there it is. T1's been hit. And now, remember, that was T1 before we had was resistance. Now it's even better resistance because, as expected, or as usually is the case, the initial tag of a price target from above, or below in this case, results in a reaction. And then that is a reaction, so that helps validate 966 as an important resistance level. And we're right around there again. Again, they're reporting tomorrow, so I don't expect fireworks until then. It might creep out. It might have a little sell-off. Let's just wait and see. And again, I'll leave it up to you if you want to hold. The problem with earnings is when stock goes against your position, it can do so in the form of a pretty good gap that can bypass any well-placed stop. So it's impossible to completely mitigate risk, at least not without paying for it. Options can hedge up a position, but you're going to pay for them. Anyways, that's that. So there it is. I still maintain these targets, still like it. T4 1161 is the current final target, and if things go well, look at this potential T5 up there around 1560, or go back to the daily chart. Enough on that one. One of my top picks right now, and as of yesterday, is GBTC, Bitcoin. Done a pretty damn good job of calling this one over the years, not just in recent years. Called many near tops and near bottoms and rallies, and long and short, bullish, bearish. I'm kind of agnostic, if for lack of a better word, to this one. I don't understand. I'm not a long-term believer in Bitcoin. I get it that a lot of people are. I don't care. I trade it based off the charts. You try to figure out fundamentals on a stock that, or I'm sorry, not a stock, a unique security that has no value, no fundamentals, other than scarcity. And again, that's even debatable because of the other cryptos out there. But there it is. Sell signal, final target hit, long trade idea, T1, T2 hit. At that point, I had other potential upside targets, but that's all I was looking for on the bounce. We exceeded it by a little bit. That was 35.71. And then yesterday hit, which is an even bigger resistance. Why? Because you have a lot of reactions there. This was a major top back here. Bitcoin broke out. It was resistance right here. We broke out. We back tested it here for a couple days. Back tested again. By the way, that was also after the sell signal. Is the bottom of the first target zone. Tested it again, and then boom, broke down. And when we did, it was highlighted as an add-on or a new short. If you didn't take the short from back here, said it should take us down to T2, and it did it within 4 days. And that was we went from 39 down to, gosh, 28 in just 4 days. That's a big drop. So anyway, point being, this one trades very well to the technicals. Hit that T3. I mentioned it as a long there. Cover any shorts and get out. That was the final target. Go long, and boom, it's been a, off T3. The rally has been about 63%. And again, back into solid resistance. So I really like it. Overbought into resistance. There are no guarantees, but it's simple stuff. I said short up to, from yesterday, we're at 39.80, I think, or yeah, 39.80. No, I'm sorry. That would have been whatever it was, 38.80. I forget exactly where, somewhere yesterday near the highs, and then boom, we hit that 39.25 to the button today. And look at the reversal so far. They've been selling it pretty good. Doesn't mean it's going to work out, but it's a good start so far. A rejection off that level, and at the very least, there's a big old gap to be filled if you just want a quick trade. But I think there's a good shot we'll come back down here to this 31.74. So that is Bitcoin, and that's Bitcoin Trust. More people have access to this than trading the cryptos directly, so that's why I'm covering this one. Or I do cover the Bitcoin futures quite a bit. BRR is the contract for Bitcoin futures, and there's a big old gap back here. You see this gap right there, lots of reactions there. So I have a resistance zone that it also ran into, about 4,600 or 46,000, excuse me, to 46,825 right there. There's a lot of reactions on there, and boom, so far a rejection off there. Nothing huge, but we have negative divergence as well. So I like these kind of trades. I'll either short rally into resistance level in which I expect a reversal, especially if there's indicators that it may be the end of a run, at least for the time being, and that's with the divergences. Or then you short a breakdown of support. Target, if you want to trade Bitcoin futures, right there. Maybe cover a little bit above there. There's a few reactions just above it. I'll give you that line, and that would be a nice swing target right about 41,550 if you want to be safe. I think it'll probably overshoot that, come down, hit that bottom level about 48.33. What does that mean if it does? That would be, let me see from where we reversed yesterday or today. About right here. Yeah, it's about an 11-12% drop if that happens. And if it comes down to this next level here, that's going to be a drop of about 19% or so, down to that 37,527 level. So there are your two targets. Target 1, target 2. With most likely, I think you'll get a reaction if we come back to that first target, because that's pretty darn good support right there. And so whether we take another leg down, we'll take a look at the charts at the time, if and when we don't even take out the recent highs, like I said. All right, next up, let's jump over to crude oil. I still very much like crude oil, and I like Bitcoin today better because crude, like I said yesterday, hit a key support level where I expected a bounce, and I said, I gave you a rough target. I highlighted that. I did, made a point to say that's a rough estimate because it's hard in this, this kind of uptrend. Crude's whippy. We could easily come up. Here's your previous reaction high, so we're still well below that one. So ideally, and it doesn't have to be this way, but ideally you want to stay below that reaction high, and I think that's what will happen. I think we'll get another leg down. And what I can tell you, if we do, and we come back and visit 65 again, we'll probably break it because we've already checked it twice. And a break of that will probably take us much lower. And yeah, still working on getting you some longer term targets. But as I said, I think a case can be made that this was a major top in crude, and kind of if you are not an active trader would have covered here yesterday because a bounce was likely. Less active trader, a trend trader, a long-term swing trader might just continue to hold tight with stops in place. If you shorted here or any of these kickback rallies along the way, that's going to determine where your stop is, your average cost. But where you start to become concerned is if we start taking back some of these levels here that I have on the chart, especially these other reaction highs right there. Nat gas, not giving up on that one. Still think it's going lower. There's our most recent divergent high. It was first, most recently mentioned as a short back here on a break of this trend line right there. And we went up, and as I said, we were slightly underwater for natural gas. And, relatively speaking, it wasn't much. Well, we're a little bit above the breakdown, and in doing so, we had just extended the negative divergence that we had up to that point. And then this is a little micro level right here, this line. Was a breakout here. We held it for a little while above these previous reaction highs right there. Failed it, and we're back testing now. So I'm still favoring a move down to this. These are all potential targets along the way, and I think we'll have a little hiccup there at 3,856. But I'm favoring a move to this uptrend line in 374. What does that mean in percentage terms? If we get it, be about a 9% or so drop from where we're at. And I'm going to continue to provide updates for gold. Gold, as mentioned the other day, as an active trade, shorter term swing trade, that should have been stopped out there. This was a support buy zone I've been highlighting for weeks. By pullbacks to that support zone. It was first a long here, a breakout there. We hit my first target, hit the second target. I had 2 more targets to go. We were consolidating in that range, and I believed it was. And in hindsight, it still was objective to go long there. But of course, as I said before, with a stop below, especially an impulsive break. So that active trade should have been stopped out, and that's near-term stuff. And charts are messy. I can't make heads or tails for an active trader. I can't make a reason to be long or short. This is, something funky. A big seller, must have been a big seller in gold. Something happened, and it also is related to the currencies. But I'm going to get to the long-term charts in a second, because I myself wear 2 different hats: active trader, long-term trader. But what happened at the very same time that gold broke down, if you recall, and I covered this that day, is that gold broke out, or the dollar broke out. We had a downtrend line and price resistance at 92.286 right there. And boom, and that's what this is all related. The dollar broke out. It was in a downtrend. We had a nice sell signal here. To me, it looked like it was going much lower, but that's the thing. It didn't get rejected where it should have been. In fact, it had a breakout, and it didn't just limp through there. It was an impulsive breakout. So far, it's moving up. Again, I can't, where it goes from here, well, I'm going to show you the longer term charts. Near term, there's not a lot I'm seeing in here to indicate. We could do this. We could put a little trend line there, and I think that'll probably do the trick. I would think the dollar is going to break down. This is quite the rip recently, and the reason it's impulsive is when it kind of surprises a lot of people. This is where stops should have been. If you were short the dollar, that's where by every metric I see on this chart, an objective stop should have been at that point. And so those stops get cleared. You get the move up, but now we have this small rising wedge with some divergences. So there it is. If you want to trade the dollar actively or gold, wait for a breakdown. The more impulsive, the better. The farther you can print a 60-minute candle below this, the better. And that should bring us back down. So there's a short setup on the dollar. Also a long trade in gold, because if the dollar goes down, gold will most likely go up. So that's what that looks like. And at the very same time that happened as well, you had the euro get rejected. Before it happened, I had this downtrend line here and price resistance at 119.15. That's where we were, and then boom, we got rejected. So although we did have this bullish falling wedge breakout, and it was a nice clean bullish falling wedge, and it resulted in a rally. The wedge would project, well, a little more upside. There's the widest part of the wedge. Add that to where a wedge breaks out, gives you a measured target. I figured we would have gone up to at least here, but guess what happened? We didn't. We got rejected at resistance, and then we've moved impulsively lower. But at this point, that was then, this is now. We have the divergence that was in place has grown even larger, potentially setting the stage for an even larger rally in the the euro. Remember, gold and the euro move in unison, because a falling euro equates to a rising dollar and vice versa. So here's your scenario. If you want to trade that, I would watch that downtrend line on the dollar I just gave you, that small trend line, that small wedge. Likewise, you have a small bullish wedge right here that I just drew on the euro. So a pop of that should take you up to the trend line. Because we had additional reactions after I added that trend line there, that helps to validate it. So you probably get most likely one more reaction. Whether you get another reaction or not, a breakout above that trend line would be bullish. Take us at least back to that 119.15 level, and then a breakout of that would be even more bullish, and then ultimately take us to these targets that I laid out before on the euro. So there's another trade idea if you trade euro futures. Okay, this is the long-term outlook for gold, and so at this point in time, I'm still longer-term bullish on gold. Near-term charts are just that. Like I said, 60-minute charts are 60-minute charts. This goes back all the way to almost to the year 2000. This is actually in 2000, October of 2000. So we're looking at a 20-something year chart right here, and what you're looking at is gold has had bull and bear market since. There's a bull market. There were corrections within that bull market. You can call them bear markets if you want to use that metric of a 20% or more drop, but bigger picture, they're just corrections within a bull market. Then back in 2011, gold peaked, had a bear market that lasted several years. We put in positive divergence. There were a lot of indicators pointing to a bottom in gold, as pointed out back then. Breakdown back test of the trend line in gold. Here's the thing, has been in a bull market since then. We're still in a bull market right now in gold, bull trend, at least by most metrics. In other words, in hindsight, from here, if gold continues to correct, I'm still viewing this as a bull market correction like this and this. But it could prove to be this. I don't think so. The fact it failed at that high, remember, we did get out, at least I got out of all my long-term positions there, went short in gold and the miners and all that, looking for this, a sizable correction, which we got. And again, it took us back to the target zone on GLD a couple times to the bottom and top of that target zone. Now, where I'm going with this, I want to just point out that we do have, let me zoom in and move this over. So we do have some developments that are concerning me. Here's a trend line, and it's decent. It's not great, but I'm circling the reactions. We've had a couple reactions, including recently, and we're just starting to break it down. Now, the week is young. Let's see how the week closes. If gold can get back above this trend line, and I suspect it will, that's going to be bullish, and we'll keep the uptrend going. So this is right now one of at least one of the key trend lines I'm watching on gold. Again, this is gold futures long-term chart or spot gold. I'm sorry, this is spot gold right here, and this shows the long-term trend. And by most metrics, we are still in a bull market, and some of those metrics are the fact, a bull trend is simply defined as a security making a series of higher lows, right? And higher highs. So we'll watch this one. We're just still above, a little bit above that previous low, and we've been, of course, making higher highs. We consolidated for a while, broke out here, and it's been strong. So if gold can do this and get up there and take out that previous high, which was just above that one, that's going to tell us, yes, we're in a longer term bull market in gold like we were back here. And so this helps drive my overall longer term outlook. Certainly, you can make a case. There's some things that recently we've seen some bearish developments on especially the 60-minute chart, but even the daily chart. But again, at any point in time, if you pick apart a security, you give me enough indicators, enough things, you can make a bullish or bearish case. And I'm deferring to the longer term charts to help formulate my outlook on the more near-term charts. For example, here, the daily chart of gold. There's that buy zone. So far, I'll roll back. You can see the whole bull market in GLD here, uptrend, what I believe to be bull market correction. And this is that buy zone. And it's been a while. The correction's been going on. We're back into the buy zone again. We've had opportunities to buy it here at the bottom, here at the bottom, here at the top. Didn't work out this last time around at the top. Didn't work out here either. We had a little bounce. It worked out here. There was a nice trade to be made. And that's it. So let's not say much more than that. As long as gold remains above 158, to me, it's in a bull market. Anything other than a little whipsaw, fake out move, flush out move down below to clear stops and suck in a lot of shorts, anything much more than that would be bullish. Okay, so this is going to take us to bonds now. Bonds aren't exciting, but they certainly are if you trade futures. They're leveraged up enough, you can make a pretty penny. If you're going to trade ETFs, you'll have to leverage up yourself on those because the moves relative to equities are not nearly as much. But they trade like everything else. They trade well to the technicals. This was a bearish rising wedge right here, nice clean up trend line. So this was our secondary or shorter term trend line. We broke it right here, as mentioned the other day, as well as that support 134, 190, and we've been moving lower since. And I'm still favoring a move down here to 132, 302. This is, I'm sorry if I didn't mention it, ZN, the 10-year Treasury bond. This is a 6-month chart with 2-hour candles, and so there's more downside there. And what this means is if bond prices are dropping, rates are going up. Long-term rates. This is the 10-year bond, and if we look at ZB, I don't know why that moved. ZB is the 30-year bond. Let me find that one for you right here. Same thing. We broke this trend line right here because now I'm zoomed down to a 60-minute chart. So this is comparable to that secondary trend line I just showed you on ZN. I'll have to zoom back out, and there'll be a longer-term trend line coming in here soon. And I don't have all the levels marked up. All I can tell you right now on this chart is it was a pretty impulsive breakdown, and we're moving lower. There was also some support. There still is. We're right on the cusp of that support right there, or the bottom of it, I should say. And so much lower is going to open the door for more downside in ZB, which is the 30-year Treasury bond futures. And then TLT, I mentioned the day when the futures broke down. TLT is the 30-year bond ETF, 20 to 30-year bonds. There was our clean up trend line on the daily chart. You see a breakdown in nothing but red sticks so far, but we are coming up on support. My first target's there about 146. Probably get a reaction there. How far it goes, hard to say, but and hard to say if we're going to take it out. Let me be very clear. I see a little more downside in the near term. And here's how it works, that's support. If it gets taken out in comparable levels on the futures, we could fall all the way back down here to 140.69, and that would mean rates are continuing to go up. So something to watch for there. Not a lot of meat left on the bone till we hit that first target, but I did want to do the update on the bonds. And then somebody had mentioned LQD, which is the corporate bond ETF, and it had almost an identical trend line. So there was our uptrend line. There was a nice clear sell signal here. Look at that red candle, solid close below the trend line. So if I wasn't highlighting this one then, but it moved in sync. Remember, investment grade corporate bonds, they tend to trade very close to treasuries. Think of a treasury as the highest level. Typically, treasuries are usually AAA rated. Investment grade bonds are also AAA, AA, single A down to double B, or actually triple B, I should say. So either way, when I look at this, I see the same thing. I see a secondary or primary trend line. Also some nice price support down there. So if, this is where I think, minor zigs and zags aside, if we get a kickback rally, there's a gap they might want to test, the top, bottom or the top. But I think we're moving down here at least to this trend line, and quite likely to 132.31 in the LQD. And again, in percentage terms, it's not much. Like, you trade bonds, I don't have to tell you that. They don't move nearly as much, and that's why you can leverage up, or just keep in mind in your portfolio, in your 401k. You might have government bonds, corporate bond funds. You might have utilities. You might have REITs, and this is where I'm segueing into IYR. This is really the first to market. There's other REIT ETFs out there, but I like to use this one. And it kind of gives you a good pulse on the REITs. There was a trend line there that was broken and back tested, and we're still below. And then a secondary trend line here we're on right now, and divergences continue to build. And so if we continue to see long-term rates rise, you'll most likely get a breakdown here in the REITs because they are rate sensitive. And so are utilities, and that would be, for example, XLU. And you can see here on utilities, they have a pretty good resistance right here. Look where they failed there. That's about $68 right there. Failed it again. Can't say failed it the other day. We're testing that level. We tested it and didn't get through it. And you have this trend line here. So I see with these divergences in place, big negative divergences, just like you had back here. Well, last time you failed it, you had negative divergences, and it was followed by a substantial correction that lasted for many months. You ran into it here. You didn't have divergence, but you got rejected. Another correction. So here's what I see. At best, I see a false breakout, a break above that level that gets sold into. It'll extend the divergences. You only have to have equal highs with lower lows on the indicators to have. So we do have negative divergence now, and any new high anytime soon, based on how much these indicators are lagging, will still be a divergent high. So that's it. So I think you either pop it, then fail it, and move down here to these potential targets that I have, $65 and $62.89. We'll call that 63. If it's still around, it's been a while since I traded it. Yeah, there it is. SDP is a ultra short, so a 2-time short utility ETF. Again, utilities are kind of what, no offense, look, I'm getting up there as well, but it's what grandma buys, typically in your portfolio. Safe haven, utility companies. They pay dividends, and that's why they are rate sensitive, because they tend to pay high dividends. People buy them as usually it's more for their income potential than growth. But there it is. So if you're looking for a trade idea, SDP, I might have to tweak the numbers here. About 17 would be your first target. Let's just focus on that one now. I haven't touched this chart in a long time. I'd have to play around with this and try to give you a second, third target, roughly there, 17, 1850, and about 2073. All right, long video. I packed in a lot of stuff. Just wanted to kind of get out there, get updates on all those. So that's it. We'll wrap it up here, and I don't see anything else today that really stands out. So we'll watch DM, see what happens after they report tomorrow. Watch Bitcoin. I think Bitcoin, like I said, offers an objective short entry, even still where we're at, with a stop somewhat. I gave you, yesterday I gave you the parameters to stop somewhat above the resistance that we just ran into. And that's about it for now. This has been Randy Finney with Right Side of the Chart. Have a great day.